dollar snapped back, which it did. Why would we expect this? Well, this is really a topic for a separate video. Most of the dollars outside of the United States are led into existence. So you always have an inelastic demand for the dollar. Now, that doesn't represent the total demand, but a percentage, a substantial percentage of the demand for dollars, especially outside of the United States, is inelastic. So we did have that snapback, but since that time, the dollar has continued on this downward trajectory where, like we said at the beginning of the video, the dollar has had its biggest decline since 1973. So to answer the question, is this the end for the dollar? And how far down will the dollar actually go? We have to understand why the dollar has gone down. Not necessarily during this time frame. That's pretty obvious. Thank you, Donald Trump. But more so this time frame, recently, in the last month. Why on earth did we snap back to 101 or 102 and then go right down to where we are today, where the dollar has been trading right around a 96 handle? We're going to get into that right now. And oh, by the way, at the end of this video, I'm going to reveal how I'm positioning my own portfolio based on the signals that we're getting from this extreme move in the United States dollar. Step number 2. Now let's talk about something called interest rate differentials. This may seem a little confusing, but it's actually very straightforward. We look at a chart going back to January of 2003. What I want you to focus on is the blue line and the black line. The blue line represents the federal funds rate, so the overnight rate the Fed sets. And the black line is the ECB equivalent. Now, the reason I'm focusing on the Fed and the ECB is because when we look at the DXY, which is what most people use as a proxy for the strength, the weakness of the dollar, it's comprised of a basket of currencies versus the dollar. But 57% of the basket is euro. So if we want to understand these concepts and what's probably driving the DXY lower, we've got to start by addressing, okay, what's going on with the Federal Reserve and the ECB. Okay, so you'll see in 2006, 2007, 2008, prior to the GFC, this is when the Fed started dropping rates, but the ECB had things on pause. Okay, then what happened when the stuff really hit the fan? The Fed took rates all the way down to zero. You guys remember this, but the ECB stopped right around about 1%. Okay, now let's fast forward to 2011, 2012. Notice what's happening here. The ECB is increasing interest rates. The Fed keeping things at rock bottom, zero. And then once we get to 2015, 16, you see the exact opposite. You see the Fed raising rates and the ECB pegging them to the floor. Now let's go ahead and look at the same time frames in the chart of the DXY. So after the GFC, and remember this is when the ECB was raising rates just slightly, the dollar got all the way down to under 75. But then what happened when we fast forward to 2015, 16, when the Fed started raising rates, and I believe at that time the ECB might have even been negative, but there's no way they're higher than zero, that's for sure. But what happened? The dollar appreciated substantially, taking us to the range where we have been for about the last 10 years, trading between 90 and 10. So what's happening here are these interest rate differentials are changing. That's just saying the difference between the ECB's interest rate and the Fed's interest rate. So if the ECB is hiking rates, the Fed is keeping them the same, then this provides a tailwind. Vice versa. If the Fed rates or paused, the ECB is cutting rates, then this gives a tailwind to the US dollar. Now let me be very clear before we move on. These interest rate differentials aren't the only thing that impact the dollar. There's thousands of variables. But this is a very strong cross current we have to pay attention to. Now, the mechanics of the monetary system at the end of the day, I think, are the overriding factor. But 6-month period, year period. During these shorter time frames, you can have significant moves between the two currencies simply as a result of these interest rate differentials, although over the long run, they really don't make that much of a difference. So now let's fast forward to 2025 and think about what is happening right now, or what has happened in the last, let's say, month or so. So if we go back to when the dollar was at 101, the idea back then is that the Fed was going to remain hawkish. And during this time, the ECB was cutting rates. So if anything, that spread was increasing, which would be a headwind for the euro and a tailwind for the dollar. So my point there is that 101 price included a hawkish Fed and included a dovish ECB. But then what we've seen over the last month is the data, the economic data in the United States has started to trend weaker, let's say, to the point where yesterday the ADP number was a negative 33,000, a huge miss considering the market was expecting a positive 100,000. Now today we did get rosier employment data that exceeded expectations, but the overall numbers are still quite poor. Doesn't necessarily mean that you're in the depths of a recession, but what it does mean is the economy is kind of teetering on the edge. It's really not strong and resilient like the mainstream media would lead you to believe. So as the data gets softer and weaker, the expectations for the Fed cutting rates and therefore reducing the interest rate differential increases. Let me show you what I'm talking about. Let's go over to FedWatch. And currently the odds of the Fed cutting in the next meeting, 4.7%. That's because we got higher than expected job numbers today. But look where we were just yesterday, 23%. And going back a month, right around 23%. So what you're seeing there are the odds of the Fed dropping increasing, which means the odds of the interest rate differential decreasing, which is going to be a headwind for the dollar. I think this really explains the extreme move down that you've seen over the past month, which has led to the worst first half of a year for the dollar since 1973. Step number 3. So now we go into trying to answer the question, how low will the DXY or the dollar go? And is this the beginning of the end for the king dollar and possibly the end of the dollar's reign as the global reserve currency? Let's start by looking at a chart. Now this is the same DXY chart, but a little bit different time frame. We go from today's date all the way back to 2005. On the left, we go from 70 up to 110. Now you guys know where we started from step number 1 and step number 2. 2005, right around 90, we go way down here, beginning of the GFC, then go right back up because everyone sees the dollar as a safe haven asset. And then we had that interest rate differential. Fed really drops, ECB not so much. And then they go up to, what was it, 1.5%? But this is the first red arrow I want to highlight where we got pretty darn low here. Let's say 75. So the dollar depreciated from 2005 to 2011. But then we had those interest rate differentials reverse and dollar rips higher up to 100. Now, what I want to point out with this arrow, and this arrow is over the last 10 years, we've kind of traded in this range. I think we might have talked about that in step number 1, but I want to highlight it again. Between about 90 and 110. So this was due to the fact that the Fed was usually a lot higher than the ECB. And therefore, just looking at this strictly through the lens of those interest rate differentials, you have to assume that we would likely stay in this range between 90 and 110, assuming the Fed continues to be higher than the ECB. But I'm sure a lot of you right about now are asking the question, okay, George, well, that's fine and dandy, but what if the Fed actually goes lower, really drops rates, and their rates go below the ECB like we saw back here? Couldn't the dollar go a lot lower than 90? Well, if that happens, then yes. But we have to think through how that would happen. So why would the Fed take rates straight back to zero? Well, you say, George, because we go through a GFC or a big recession or something like the cervasis sickness or even a balance sheet recession like we saw in 2001. Okay, fair enough, but if the United States goes into a recession, what's going to happen to Europe? Because all the problems with the United States, you want to look at the deficits, the debt, the spending, this allocation of resources down to zero because things are way worse there, I think is extremely low. So to answer the question, to the best of my abilities, and again, we're not talking about certainties, only probabilities, is this the dollar end game? Absolutely not. Because although the dollar isn't going to be the world reserve currency forever, in order for it to not be the global reserve currency, the monetary system has to fundamentally change. And just because we have a BRICS currency potentially, or a gold-backed currency, or because foreigners are dumping treasuries, this does not change the structure of the monetary system. As an example, what would change the structure of a monetary system is a wholesale central bank digital currency, but that's a topic for a separate video. And until we get to that point, I think the Fed is going to likely be higher than the ECB. So to answer this question, or just give you my base case, the low on the DXY, probably around 90. I wouldn't be surprised if it gets into the 80s, but if I had to put money on it, I think this support level would hold up. So then the big question becomes, okay, George, well, I get what you're saying here, but how should I set up my portfolio? I mean, what should I do based on these signals that you're talking about in the DXY? And if you guys remember at the beginning of the video, I gave a little teaser there that I would tell you how you can get access to, or I'd reveal what I'm doing in my own personal portfolio to not just survive this action, but to actually profit from it. I call the video the dollar playbook. It's how George Gammon is trying to profit from these big extreme moves that we see in the dollar that we haven't seen since 1973. And you can get access to this free of charge just by clicking on the link in the description of the video or the link in the pinned comment. I'm going to go over step by step how I'm putting on what I think is an asymmetric trade to take advantage of everything we discussed in this video. And I'm going to go over the charts and the historical data to back up my position. This dollar playbook is definitely something that you're going to want to check out. Again, you can get it free of charge just by clicking on the link in the description of this video. One of the Federal Reserve's favorite recession indicators was just triggered. But what does this actually mean? Are we going to have an economic contraction? Is the stock market going to go down? What the F is going on right now? I'm going to do my very best to answer those questions for you in 3 simple, fast steps. Step number 1, let's go over this crazy, crazy yield curve and how it just inverted again. We look at a chart, today's date going all the way back to October or so of 2024. On the left, we start at 0 way up here, and we go up to 50 basis points. That's 0.5%. Then we go down to a negative 125 basis points. Put negative there, but you guys get it with the red numbers. So this is the 3-month Treasury yield versus the 10-year Treasury yield. Probably a better way to say that is the 10-year Treasury yield minus the 3-month Treasury yield. So we go back to October of last year, and the curve was massively inverted. That means the 10-year Treasury yield was actually lower than the 3-month Treasury yield, something that really shouldn't happen. I mean, you can just use some common sense and think about lending your buddy $1,000 for 10 years versus 3 months. Which one are you going to charge him a higher interest rate? Which one do you have more risk for inflation or not being paid back? Obviously, for 10 years. So you're going to charge him a higher interest rate the longer you lend him the money. This makes a lot of sense, and this is usually why in a healthy environment you would see a steep yield curve. So yields would be lower at the front end of the curve the shorter maturities, the less time you're lending the government money. And as that time increases, the yield would get higher. So the bottom line is when you see this inverted curve, or on this chart, anything below zero, that is bad. But what's interesting is when you get above this dotted line, after being below the dotted line, we go from bad to being very bad. And you're probably saying to yourself, George, well, what? That doesn't mean, if this is bad, that's got to be good. But if we actually look at a chart going back, let's say, to the 1970s, and we look at the 3-month versus the 10-year, we see that usually the stuff hits the fan. In other words, we have that economic contraction, not during the inversion, but after the curve uninverts. Then we fast forward to January 2025 or so, the curve steepens out, the 10-year Treasury yield gets to a point where it's maybe 40 or 50 basis points above the 3-month, which is more along the lines of what you would expect in a healthy, growing economy. But actually, historically speaking, the 10-year Treasury yield is usually about 1 to 1.5%, 150 basis points, above the front end of the curve. So we are still nowhere close when we were at 40 or 50 basis points. But then what we had is the 10-year Treasury from that point start to drop down. And more recently, it's absolutely plummeted to a point where now the curve has re-inverted again. So if this is bad, this is very bad, but this is flat out bizarre. So now let's step back for a moment and ask ourselves, well, what on earth is actually going on here? Because this is just a visual representation of prices and what the buyers and the sellers in the Treasury market are actually doing. But we've got to think through why they're doing what they're doing. Why are they buying so many 10-year Treasury yields that brings the interest rate down? Remember, there's an inverse relationship between the price of the Treasury and the actual yield. Usually, it's these financial institutions, the mega banks, the hedge funds, the pension funds, in and outside of the United States, looking at their balance sheet, saying, okay, well, what are we going to do? We could go out there and lend into the real economy, or we could just buy treasuries. So at the end of the day, it's really about risk versus reward. If you ran a bank, you'd be doing the exact same thing. You'd be asking yourself, okay, I can go ahead and increase the size of my balance sheet by giving a loan to a global corporation, and I might be able to get 6% interest. Or what I can do is take that same balance sheet capacity and I can buy a 10-year Treasury yield up here, let's say, at 4.8%. Well, I like the 6%, but boy, oh boy, that's way too risky, because I look out into the horizon and I see storm clouds, economic storm clouds. I see a potential contraction. I don't like what's going on. So in that case, I would much rather have the 4.8% on the Treasury, because the risk is a lot lower. See what's happening here. As the perceived risk in the global economy increases, then there is a greater desire to have safe and liquid assets on your balance sheet, and therefore you're going to buy things like the 10-year Treasury yield, which brings the interest rate down. So the next question becomes, is the yield curve always right? And the answer is no. It's got a very high hit rate, but it's not always right, let's say 90% of the time. And it's very difficult to actually use the yield curve to predict when the recession is going to hit, other than this basic analysis of looking at when the yield curve goes from being inverted to uninverted. And I'll be the first person to admit that I've been talking about this for a long time. And my base case is that we would have already had a recession, because usually that economic contraction hits within that 2-year period. But another thing that I'll say is this, meaning the Treasury market, is not just the bond market for the United States. It's really the bond market for the global economy. And if you look at what has happened over the past 2 years outside of the United States, it's a much, much different story, which would make more sense when you're looking at this inversion. But I know right about now, this guy is going to step into the picture, especially in the comments. And it is your friend and family member, Fred, the guy that's always nagging at you, telling you that George Gammon doesn't know what he's talking about, and he's just fear-mongering. And what you should do is just buy the S&P and listen to Jim Cramer and just bury your head in the sand like an ostrich. And it's not about timing the market. It's all about time in the market. And it's not about buying things when they're cheap or selling them when they're expensive. It's all about just predicting, well, just knowing for sure that the stock market always goes up. Therefore, anyone that has a contrarian view is just spewing misinformation and disinformation. You should just ignore them. It's a very similar view to the mainstream media, oddly enough. But what this misses is what we were just talking about. It's not the fact that the yield curve is predicting a recession. I think that's missing the point. So said another way, it's not about the curve inverting. It's about why, asking why there are so many financial institutions that are taking their balance sheet capacity and buying 10-year treasuries instead of going out into the real economy and using that balance sheet capacity to get a higher interest rate. This is really the key. And it's why we have to include the yield curve in our analysis, even if it's not always correct or it doesn't give us much information as far as the timing of an economic contraction. Step number 2. Now let's dive into the see this bizarre move we've just seen. The Treasury curve is actually unprecedented. And then at the end of this, say these huge financial institutions